Today's video is sponsored by Figure, the largest non-bank home equity loan lender in the US, with over $15 billion unlocked on their lending platform. They're now in the crypto-backed loan space and offering industry-low interest rates when you use your Bitcoin as collateral to get cash. Access interest rates starting at 9.9%, the lowest fixed rate in the industry at 50% LTVs. Whether you're funding a major purchase like a down payment on a home, investing in new opportunities, or even buying more Bitcoin, Figure makes it straightforward and transparent. Visit figure.com/Real Vision or click on my link below to take out a Bitcoin-backed loan with Figure today. Hi, I want to talk to you today about my friends at Bitwise and why they're the best crypto asset manager out there. I've talked on the show often about how crypto is reshaping everything from finance, portfolios, and even macro. Everything's ramping up. We've got tailwinds in DC, interest from TradFi, and growing optimism. But smart investors see all of this and focus on the how. What's the savviest way to seize this moment? And that's why so many investors I know are working with Bitwise today. They've been all in on crypto since 2017. They're OGs. They've got more than 30 products to help investors like you get access to whatever they need or want. They've got a team of more than 100 across the US and Europe, and they have over 10 billion in client assets. You know, a lot of people know Bitwise for their ETFs, how they manage the world's largest crypto index funds and the wide range of crypto ETFs they have. But not as many people realize, Bitwise manages private alpha strategies too, and has SMAs for large investors, and is one of the largest institutional Ethereum staking providers. They really do everything. These guys are true OGs in the space, and they're good friends of mine too. So please go and check out Bitwise. They're really excellent. Go to bitwiseinvestments.com and see all that they've got to offer. That's bitwiseinvestments.com, or just email them at james@bitwiseinvestments.com and let them know that Raoul sent you. Anyway, there's a million ways to access crypto. Explore how you can access it best with Bitwise. And remember, carefully consider the extreme risk associated with crypto before investing. Anyway, thanks so much.
Hey Real Vision viewers, a quick pause to introduce you to today's sponsor, Axelar. Axelar is building the rails for the next wave of global finance. Not just crypto, but the future of how assets move, how markets connect, and how institutions plug into open systems. Think of it this way. Bitcoin brought digital gold, Ethereum brought smart contracts, but Axelar is bringing connectivity, the secure link between your favorite blockchain and traditional financial institutions, rushing to plug in. It's why top-tier firms like Dragonfly, Polychain, Coinbase Ventures, and Binance Labs are backing Axelar, and why global giants like Deutsche Bank, MasterCard, Apollo Global, and JP Morgan are already building on it. If you believe the future of finance is open, programmable, and interoperable, Axelar is the gateway. Want to digest deeper? Visit realvision.com/Axelar or follow on X at Axelar. That's AXELAR, the gateway to open finance. Today's video is sponsored by VeChain, the leading layer 1 built for real-world adoption. VeChain launched all the way back in 2015. Built for real-world utility before most people had even heard of blockchain. One of the oldest protocols and boasting 100% uptime since launch, it's known for powering real-world solutions and partnerships with global brands like the UFC. Now, they're entering a new, user-focused chapter powered by adoption in the VBetter ecosystem and an ambitious technical roadmap dubbed the VeChain Renaissance. Renaissance builds on VeChain's history of real utility and adoption to deliver a faster, more flexible core protocol, designed to meet the needs of builders and drive mass adoption. The next phase kicks off on July 1st with the launch of Stargate, VeChain's new staking program. It's an evolution that brings VeChain closer to delivering its vision of a world powered by Web3 without compromising on reliability or stability. The future is here, and it's scalable, sustainable, and evolving with purpose. Check the links in the description to find out all you need to know about VeChain Renaissance and the updated staking opportunities available through Stargate.
Hi, I'm Raoul Pal, and welcome to my show, The Journeyman, where I take you on that journey of exploration to the nexus of macro, crypto, and the exponential age of technology. As you know by now, what I try and do is follow a lot of themes along and keep moving them forwards to increase my understanding and also your understanding of where we are in this journey of the exponential age. One of the core things is the adoption of crypto, and I've been on this since 2013. One of the key things is how the financial system is going to deal with it. And that's starting to open up massively. So who better to talk to than my great friend Sandy Kuhl from Franklin Templeton? She's a great sparring partner for thought, and we can dig into all the things surrounding what is really going on here. Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Sandy, welcome back to Real Vision.
Wonderful to be here with you, Raoul.
It's always fun conversations with you. I don't know where we're going to go with this, but we'll go somewhere.
100%. Let's dive in.
Yeah, so let's just quickly introduce yourself for those people who don't know you, just so they frame up what we're going to be talking about.
Great. Sandy Kuhl. I'm the head of innovation at Franklin Templeton. And I have been doing thought leadership about the future of the investment and wealth management industries for almost 20 years now. And wrote my first report on tokenization and how it was going to change our entire financial future back in 2017. So it's great to be here with you and seeing the world unfold as we foretold. Very exciting days.
It seems to be all happening all at once.
Yep, that's always our key, right?
I mean, at every angle, everybody everywhere is approaching this, from stable coins to we're going to have equities on chain. I mean, you've seen this coming, but it's moving really fast suddenly.
Yep. It's very exciting. I mean, I think that we have moved so far beyond this idea of, are these usable technologies? Are these tradable marketplaces? Is this some digital scam, right? Those are so far in the past, those days. And I think what we're seeing now is a very institutional marketplace. We've got perpetuals, we've got ETFs, we've got all sorts of prime brokerage opportunities. We've got financing opportunities. We've got an institutional infrastructure. We've got growing sets of institutions participating. And I think that what is starting to really dawn on the broader financial industry is that these are the rails of the future, right? And that this is where we are going to see the industry head. And these days of session-based regional markets with T plus whatever settlement, those days are ending. And so as people are starting to realize that, there is now starting to be this rush to get into the ecosystem in whatever way possible, because people are starting to wake up to the fact that everything is going to change. And the people who have been successful intermediaries in the past are under tremendous threat. And I think that this is where you're starting to see a lot of new entrants come in. You're starting to see new models being explored, and you're starting to get a sense that the traditional firms are starting to rush to catch up. So I think that it's a combination of acceptance, regulatory acceptance with a more friendly U.S. administration, the MiCA laws now in place in Europe, more regulatory clarity coming out of Asia and the Middle East. I think it's a combination of the big financial traditional institutions realizing that there is a massive change about to happen, and they're panicking and really starting to accelerate their pace of entry. And I think that there are a tremendous number of new entrants who get it now, who get that the crossover is going to be between traditional finance and crypto. It's not going to be one or the other. And they are taking advantage of that point of view to really get out there with new models that challenge the orthodoxy of the industry. So I think it is all happening all at once.
Ever wish you could access cash without selling your Bitcoin? Ledn makes that possible. Ledn is the global leader in Bitcoin-backed lending. Since 2018, they've issued over $9 billion in loans, and not a single Satoshi of client funds has ever been lost. Here's what makes a Ledn loan different. With a custodied loan, collateral is not lent out to generate interest. There are no credit checks. Funds in less than 12 hours, no monthly payments, and repay whenever you want with zero penalties. And they just don't talk security, they prove it. Ledn offers proof of reserve reports verified by a top accounting firm every 6 months. Ledn is 100% focused on doing one thing better than anyone else, giving Bitcoin holders a secure and transparent way to unlock liquidity without selling. Learn more at www.ledn.io. And how do you deal with it without having your hair on fire all day, with prioritizing what you want to do at Franklin Templeton? What are the things that really matter for you guys versus the generalized, everybody's doing something, so it has a feeling of, oh my God, we need to do everything. And what are you focused on? What are the core priorities for you guys right now?
So we've been very lucky, Raul, in that we saw this coming for quite some time, and we have been diligently building out our infrastructure. So I think unlike many other players, we have an infrastructure that has been custom built to operate in this new ecosystem. And the functionality that we have built, I think, positions us to act like a digital native while being a traditional financial firm. And that creates great opportunity, right? So if you think about our priorities are, really using the tokenized money market funds we've created globally, that are available globally, as rewiring the way that collateral works and the way that people can move seamlessly between stablecoins and tokenized money market funds. And then you need to go back to your core principles. Who are you? Right? We are an asset manager. And so this opening up of the real world asset opportunity has really created, I think, a great potential for us to really start to migrate our investment portfolios into these new rails and into these new audiences, and do so in a way that is in line with where the industry is today, which is very personalized, very flexible portfolios, not traditional standard 60-40 portfolios, but really rethinking, what does direct indexing look like in a tokenized world? What does personalized and customized tax optimized solutions look like in a tokenized world? And I think that is where we're going to leapfrog to. I don't think it's going to be individual equities. I don't think it's going to be ETFs. I think it's going to be, how do you use these new rails and new wrappers to create portfolios that really are 21st century portfolios, not 20th century portfolios.
So to address the first part of that, the money market funds, who are the users of these and who do you envisage onboarding in the money market funds? These are, I guess, wholesale products for institutional players, or does it go down to retail level? What is the big picture thinking with the money market funds?
Yeah, so there's a couple things there. For, I think, the institutional marketplace, this is clearly a alternative to using stable coins for global cross-border trade, because you get both the programmability of the token wrapper to be able to use in a tokenized fund, and you get the yield that comes with the fund natively, right? So we see this as a great alternative, perhaps a superior alternative to stablecoins for cross-border trade, all sorts of trade financing use cases, supply chain use cases, shipping use cases, right? Treasury use cases, all of which, are going to be enabled because these new rails offer new capabilities. So we, for the first time, are able to upgrade the way that a money market works, right? We are able to do a second by second shareholder record. And therefore, if you hold assets for just 2 hours and 32 minutes of the trading day, you can get 2 hours and 32 minutes worth of the trading day's yield. Whereas today, you would not get any of that yield unless you were holding those positions at the close. We're able to pay out that yield every single calendar day, including Saturdays, Sundays, and holidays, because we're doing it through incremental issuance of new tokens, and the token is our digitally native exposure to the fund. So we're able to give you more cash certainty and see that cash yield being distributed daily rather than monthly, which is the case with most money market funds. So I think that these abilities, along with the peer-to-peer transferability of our tokens, is what's really going to reposition these money market funds for an institutional audience. But what's really cool with Franklin Templeton is that we also have tokenized our 40 Act retail fund and delivered it via an app, right? And so any individual in the US can sign on and they can trade amounts as low as $20 in our tokenized money market fund. And we've built the peer-to-peer transferability so that you can use it just like you would use Venmo. You can transfer your money market fund shares as payments between accounts with your friends. You can use it in any way that you would any other type of cash management account, yet you get the yield on all of those transactions. So we're both excited for the retail opportunity of really expanding the set of tokenized instruments that you can use to improve your own finances, and for the institutional use cases.
The difference over stablecoins is the yield, and yes, stablecoins with yield are coming, but the difference with money market fund, it doesn't have to be in treasuries.
That's right.
It can be in a range of yielding assets. So there's usually a yield pickup, is that right? Versus holding it directly at a bank or even the treasury market.
Yeah, there's a yield pickup. There's a repo opportunity in there. So you can get a little bit of extra fee through the repo opportunity. And there's also, I think, the regulatory protections that you get by using a registered fund as opposed to this new type of cash instrument where the rules are still being set, the reserve pools are less certain, the transparency is not as clear, and the fees that are sometimes hidden in these funds, particularly for institutional users, are not transparent. So I think that there's a number of advantages to tokenized money market funds. And then if you look at MiCA and you look at the Genius Act that just passed in the US, they specifically forbid stablecoins from paying out yield. So I don't know how quickly yield-bearing stablecoins are coming in regulated jurisdictions. And there is likely to be much more of a KYC AML component to stablecoins, which could really begin to curtail some of their use because the issuers and the managers of these stablecoins are not really the entities able to perform that KYC AML. So I think that there's, I think stablecoins have been an amazing bridge to the new future, but I don't know if they're going to be quite the same killer app that people thought at one point.
How, just so people understand this, how big is the money market fund market?
So just in the US, the money market fund is $7 trillion in money market funds in the US alone, right? So, I mean, we're talking a tremendous market here when you think about the opportunity space, right? And that's today with them just basically being used for institutional use cases. This is before we open up all these new use cases.
That's a monstrously large market. It feels like it's a much more efficient way of doing it. Just the yield, because things get stuck in the financial system and some people capture the yield, others don't. This makes it much more efficient. It feels like it's pretty obvious that this is where it's going. But what struck my interest is if you're offering the same to individuals, why do they need a bank?
Well, this is one of the intermediaries that I think have to really seriously rethink what is their role in the emerging economy. First of all the banks today are account-based. Not a single bank that we know of offers a wallet-based system to manage exposures, right? So they're going to have to retool dramatically to be able to compete in this space. Most banks today are looking to tokenize their deposits or tokenize their liabilities, which is basically locking in their account-based structures. This feels like a very defensive play, right? This is not really thinking about the native rails that you can build upon and re-envisioning what your products could look like if they were running on native rails. And because of that, you don't get the same utility out of these assets that you would get if you had a digitally native instrument. And this is what we're already seeing with money market funds. I mean, plenty of people have tokenized treasuries or tokenized money market funds, but they're not really utilizing the native capabilities of the rails because they're still settling those securities in the off-chain system. We're among one of the only firms globally that has been able to build an on-chain system that our entire set of books and records is on-chain. So we're able to operate at the speed of digital rails, whereas many others are really waiting for that 24-hour or longer settlement window to pass. So I think that there's, I think understanding of the nuances of the products that are in market today are going to become more clear over the coming months, and the advantages versus the disadvantages of these different tokenized money market funds will become easier to understand, because they're really not all the same, right? There's very significant differences in the products in the market.
And how do you onboard clients? So it's all well and good building a great product, but how do you get clients to do it? Because they need to understand wallet experiences, the new way of settlements. They've got to get their systems working. How's that process going?
Well, what's been super fascinating is that it's actually coming a lot through reverse inquiry, right? Like, I think that these, particularly corporate treasurers and sourcing officers, really understand that if they can get into stable coins and tokenized money market funds for cross-border trade, it removes tremendous layers of fees and tremendous delays in the way that they can receive and disperse capital. I think that they're starting to really even front run where the financial markets are in terms of looking for these opportunities. And because these systems are being built from scratch, like we built our system from scratch at Franklin Templeton, it's entirely API enabled, right? So we have already done test cases where we have built our system into enterprise resource management software, and they've been able to run their enterprise resource management software straight through using our API without having to do any real retooling to their reporting or payment systems. So it's pretty interesting what you're able to do because of the way that these new technologies are being architected.
So let's talk about the second point that you raised earlier, which was about construction of portfolios, because this is an interesting thing. How do you envisage it's going to change? Right now we have, whether it's wealth management firms or advisors, whatever, or ETFs and direct access, kind of plain vanilla products. Everything else you can't really get access to unless you're a high net worth. What is in your head where this is going?
Yeah, I think that, you've started to see this shift in the US from obviously standard funds that you would put together 5 or 6 or 7 different funds to have a portfolio, to a model portfolio where you basically have a recipe that has all the components of a fund in it in the correct measurements for how you put one portfolio together, to direct indexing, which is basically taking the holdings of ETFs or other investment funds, looking through to the underlying securities that sit in those portfolios, and then optimizing them for the individual. And those optimizations are pretty basic right now, right? I work in a financial services firm. I used to work in a bank. I might not need as much exposure to the financial sector in my portfolio because the way I get paid, I have a lot of exposure to that sector. So they can dial down my exposure to the financial sector in my portfolio. And they can look at all of my positions in my portfolio, and they can optimize my tax situation by looking at my tax lots and actively managing my tax lots. So it's a pretty basic set of personalizations, but it is at least trying to tune the portfolio to Sandy, not give me a generic portfolio. This is tough to do in the markets today. I need to be able to deploy an entire system of separately managed accounts. I need to build specialized software that can really take in and analyze all of these different positions. I need to connect it into the technology that these brokerage houses have built, and these wirehouses and wealth management platforms have built. I need to be able to automatically rebalance all of these positions, right? It's a lot of tech-driven lift into systems that are old and all mainframe based, right? If you think about taking the concept of what they're trying to do, looking at each individual holding in a portfolio and optimizing the way that it's being utilized, this translates really well to the blockchain-based and wallet-based ecosystem. We're already, right? We're already seeing, we saw the announcement of Robinhood about their launch of their new platform in Europe, where they're going to be offering tokenized securities and tokenized ETFs, right? This is going to happen faster and faster. So I can take each individual component of a portfolio and have it be sitting in a wallet. And then once it's a token, my portfolio becomes a token of those tokens. That's my total portfolio. And I can start to use that that token level portfolio as its own asset, right? I can stake it, I can pledge it, right? So I think that you're going to start to see the utility of both how we construct the portfolio to make it more and more aligned to the individual, and the way that we can utilize the portfolio to create more earning streams and more opportunity for the individual, both really explode now that we're moving it off of these very limited old technology rails and moving them onto this new set of blockchain-based, wallet-based ecosystem.
And does that not also apply at the larger market scale, the corporate treasurers and stuff like that, who have a complex set of needs and they want to maybe break apart some of the component parts, as you said, because this composability, recomposability element of tokenized portfolios means that they can strip out, let's say they don't want any more whatever exposure, Swiss exposure, because whatever reason, and so that they can just retool whatever their money market fund or whatever their holdings are.
That's right. I think that's going to be the next big step that comes.
Because if not, they right now would buy a fund.
That's right.
And what's in the fund is their problem. They might have to hedge against some of it if it's against their mandate or they don't need it or whatever. But this allows them to personalize that.
That's right. And the way they hedge that out today, Raul, as you know, right, is through all these overlay strategies and option strategies that actually cost them a lot of money, right? That can leave, that really up the expense of managing these treasuries. So I do think that that's going to be a big next step. And then I think beyond it raises even a bigger question, right? Which is, if I'm tokenizing an exposure and that exposure is sitting in a token, why does it have to be an equity, right? I do think we're going to see a complete rethink of the capital raising ecosystem coming from these big institutional players. And let me make it super simple, right? On Amazon, right? Why do I have to bundle my Amazon retail services and my Amazon web services and my Amazon logistical services into one stock price, right?
That's right.
Why not have 3 tokens that give exposures to different parts of Amazon's business? And that immediately gives me, as the management team at Amazon, more insight into how the market is looking at how I'm managing my businesses as well. So I think that this idea that we need an equity to have exposure to a company is going to really come under challenge in the next few years, because there's more efficient ways for me to be raising capital for parts of the company that make more logical sense for each other. And I think that we're going to see the issuance of new types of corporate exposure tokens pretty soon. Like, I think that once people get comfortable with this idea that a token can hold any type of exposure, the need to issue an equity and be a public company and be subject to the exposure and all of the scrutiny that public companies get, we might see a real shift in thinking around how do big corporations raise money in the future.
And also, what does it mean for VC? What does it mean for private equity? We've seen, Robinhood is blurring that boundary really fast, and Republic and a few others are, which are tokenizing private vehicles like SpaceX.
Yeah.
Okay, that's interesting. The later stage. But what basically a lot of crypto is already is just early stage that is tokenized as opposed to equity, and some do token and equity to make it even more confusing. But it feels like the capital markets are changing structure in front of our very eyes, that things like the Circle IPO are going to be less and less relevant in the future because, as you say, what is an equity, what is a token doesn't matter, because once the regulation is cleaned up, they can accrue rights, they can accrue dividends or economic rights, whatever it may be. And therefore, my idea for a long time was using a company as complicated as, let's say, Exxon.
Yeah.
A lot of people just don't want to invest straight up in an oil company, but they've got hundreds of different businesses within a company like that. And to be able to break it down, it becomes a much better business for a CEO to run, because you've got more efficient capital allocation, because the market's giving you signal. You can decide what needs capital, what doesn't need capital, all of these things.
Well, and, to build on your point, because I think you're 100% correct, Raul, and to build on that point, one of the most difficult parts for these corporations is, how do I fund sufficient research and development while making sure that all of these different businesses are funded adequately to grow. And I think that opening up research and development, is going to be huge, right? Because a company really has, if you think about it, all the different stages of investment in it. You can have venture through their research and development arm. You can have early stage through new business launches. You can have growth stages as new businesses really start to become a more important part of the company's economic ladder. And then you can have later stage and value portions of a company based on their most successful and most established business lines. So, you could actually really start to break every company down into the full range of the equity markets and trade every part of that ladder within a single company.
Yeah, and Google's another great example. Alphabet's a great example of a company that people would love to be able to invest in some parts of and not other parts of, because there's some really interesting stuff. The issue I've got with all of this is the question is, what is a token? What is equity? What happens in M&A? What happens when tokens don't die? Equity does die. What happens when a line of business goes bust or whatever? It's just, there's still a complexity around what the hell this thing is.
Yeah. Well, this is where I think the programmability of tokens is going to become the real focus of discussion, right? We've kind of treated tokens as this kind of very generic wrapper, but a token is a lot more than a wrapper, right? A token is programmable. And with many of these blockchains that they run on, you can have smart contracts. More and more of these blockchains are bringing agentive AI into the monitoring and the administration of their smart contracts. And I think at that intersection is where we're going to start to really see some sophistication build into the marketplace. So if you think of the early days of crypto, it was buy or sell, right? Then we started to get derivatives. We started to get perps. We started to get staking. We started to get all of these new models that made this very basic marketplace increasingly attractive and opened up more and more opportunity. And I think you're going to see the same thing happen around the wrapper of the token itself, right? We still think of a token as a pretty straightforward wrapper, but it can be much more, right? It can almost be I hate to use the term smart wrapper, but you can start to program it and you can start to say, if business profitability falls below X, this becomes a distress token and new rules come into effect. Or, if you hit a certain stage of growth, this is now going to switch from being a venture token to a growth token. And that can be programmed into these contracts so that they can actually morph and change and respond to market conditions that can be delivered, and the data needed to really feed those potential changes can be delivered via oracles. So I think that you're going to see a real rethinking of what does a wrapper need to deliver, and can we use this to really help evolve these instruments to become growing and shifting instruments, just like we've seen machine learning start to increase and allow AI programmed activities to become more and more sophisticated. I think these wrappers themselves will become more and more sophisticated.
Yeah, I mean, it's super interesting. And just thinking about, the centralization of the big corporations or the decentralization of a tokenized corporation, right? And then the ability to what kind of portfolios, to go back to your previous point, is like, okay, now what does your portfolio look like? You could have oil income streams and real estate in Manhattan, and you can have crypto exposure and you can have some tech exposure. It's like it becomes super defined in what you can do in a way that does not exist now.
Well, and you can be very deliberate, right? Like you can really start to get down to, what is my specific goal, right? What do I need? How much money do I want to have in retirement? And what is going to be the fastest way for me, for my portfolio to get me there, right? And it can isolate different income streams that have different degrees of confidence about their repeatability. You can have, high risk income streams that might pay off much more than you think versus completely conservative, steady income streams. Like we've used bonds as just a fill-in for what could become a much more nuanced ecosystem around how do you create income in a portfolio, right? I think that's just one example of what might change so profoundly when you have all of these very distinct and very targeted opportunities that you can utilize to build the portfolio.
Sandy, the other thing that makes me think, and we touched on it before, is the nature of the capital markets and how you raise capital changes. Because now you can be a technology company or a manufacturing company who say, I want to raise money for a specific thing, and it's not a generalized pool of capital, and people get access to that specific return. So it creates a lot more specificity, which is an easy word for you to say, difficult for me to say, in capital raising as well.
Yeah, and I think that is where I think the new thinking around how do I manage an organization. Forget it doesn't have to necessarily be a company, because we're seeing the same thing come up with these foundations, right, that are running the different blockchain-based businesses. How do I think about my goals as an organization? And how do I think about opening up participation and ownership in a new way, right? Ownership used to only be, I could own a share in the company, but now ownership can be participatory as well. And so, I might actually want to use expertise from outside my organization and offer people with that expertise benefits through having special classes of tokens for people who contribute to my projects, right? So it could even change employment.
Let's say Microsoft have the world's best corporate treasury, let's say, and they could then just basically tokenize that ability to manage it for other corporations. It kind of
Exactly
decentralizes asset management at scale as well, because of different people have different skill sets. Commodity trading houses are very good at certain things, whether it could be currency overlays, and then before you know it, you're getting their currency overlay from you because they offer a token that offers it, which is extraordinary.
Yeah, and it becomes a marketplace, right? Your idea marketplace, your capabilities marketplace grows to such an extent. I mean, today we have maybe 1,000 investment firms globally that are managing money, 2,000 firms globally, right? You could have hundreds of thousands of specialty firms that are each offering their own expertise that you can access and put together into a portfolio of services. So it really this idea of decentralization, right, goes much further than we've been thinking about it today, right? We're at I think, just the very, very beginnings of unpacking what a decentralized economy might look like.
The other side of it is everybody wants to tokenize their funds, whatever fund it is, equity funds, private equity funds, real estate funds, all of that stuff. A lot of them just want to do it to get to retail because they want to scale, particularly the private equity guys. But it feels that, talk me through where's your head with the tokenization of the kind of existing fund business, and then we'll talk about what it might look like in the future, because I think we're pulling on this thread that whatever we see today and whatever tokenization happens is not where it's going.
Yeah. So I think for today, the way I look at it is, I think it's going to be a barbell, right? I think that the reason that there's so much interest in tokenizing these private funds isn't so much about the fractionalization of those fund exposures, or isn't so much about this ability to democratize access. I think a lot of what's happening in the tokenization of the private fund space is about creating operational efficiencies and creating some ability to share standards, share information and share data in an industry where there's no real standards. So it's very complicated to onboard different private funds today to, say, a big wealth management platform, because each private fund has its own documentation, its own data fields, its own way of creating valuations, its own way of calling for capital. There's no standardization whatsoever. So by tokenizing some of these processes, I think a lot of people see just adding efficiencies and taking costs out of the private marketplace. And even if you're not using it to provide direct exposure, there's lots of opportunity there. But then at the opposite end of the spectrum, I think it's going to be the most liquid things that go to become tokenized first. And you're already seeing this, right? We talked about tokenization of equities, tokenization of ETFs. These are the most commoditized products we offer. And by moving them out of their traditional kind of offering platform onto a tokenized platform, we're actually being able to take cost out of these instruments. We're actually creating more velocity for being able to move these instruments and more utility, because now they can start to be used in different kinds of financing arrangements and in different kinds of staking arrangements and in different kinds of liquidity pools in a much easier manner, right? That used to be something only the most sophisticated institutions could afford to do, but increasingly it's going to become something that just becomes second place for everyone.
There's also, there's no secondary market liquidity in a lot of these things. And, at various points in the business cycle, people have got locked up in a VC fund or a private equity fund and they want to get liquidity. Yes, you can get some, but it's very illiquid. But, it's going to create that. But then that creates, it creates an arbitrage between the NAV versus the tokens, which is good because it creates liquidity around the ecosystem. I can see a lot of that. The one that comes up a lot is the one that I'm least excited about. I thought I was excited about it, but I'm not, which is tokenizing real estate. And the reason being is every person who comes up to me and said, can you help me with this, is somebody who wants to sell real estate. I've not had a single friend or single person I know say, I'd love to tokenize a part of an apartment in Manhattan, because young people just don't want that exposure. It just doesn't make meaningful returns compared to the returns of the things that they prefer, tech stocks, crypto, stuff like that. So I don't know who the buyer of that would be.
Yeah, I think real estate, it always did seem like that would be the easiest and first place to go.
The title deed,
I
sure, all of the contracts and stuff for sure, but the actual real estate, I'm not so sure anymore.
We've actually looked into it a few different times over the past few years, and there's problems. There's problems with the way that you do the valuations. There's problems with how do you, look to exit, right? If you're only owning a portion of a piece of real estate and you want to exit, what does that look like, right? So I think that there's logistical issues around real estate as well as kind of, I think, interest issues, right? I do think that there are other assets that are much more appealing to people, and that I think that real estate is also something that people are starting to have very different views around, right? And you're seeing that because of the difficulties of getting into the housing markets and the housing ladders. I think that people are looking for things that are more accessible to them, right? So I agree. Real estate seemed like that was going to be kind of a slam dunk first pass. Now what we're really seeing is it's much more the efficiencies around real estate that people think there's opportunities in, like moving titles and moving land grants and things onto blockchain-based rails rather than tokenizing the actual investments in real estate.
The other thing that, we're certainly pushing towards at Real Vision, and I think will happen, is like this whole market of hedge funds, which is basically investing in people who have excess talent in managing money in whatever markets. And what we're seeing is that you can basically prove somebody's abilities in a community. And then if they tokenize it, I can tokenize Sandy's trading portfolio. Right now, Sandy's a hedge fund manager and gets paid, which is incredibly disruptive considering the hedge fund industry is a $4 trillion industry. And suddenly everybody can essentially become a hedge fund manager. And that, again, puts the power back into the people as opposed to these lumpy, complicated corporate structures to make it super easy.
Well, and you and I, right, we both have hedge fund backgrounds. And so really, what is a pod structure for a hedge fund, but a platform? It's really just a platform play. And if that platform becomes something that you can offer out in general, right, there's a huge opportunity in that. I will say, though, the one piece that I do think about, because as you're exactly right, you can find all sorts of opportunity and anyone could really become, in part, a hedge fund manager. One of the things that do make these platforms very successful is the way that they allocate capital at the top level from a risk perspective. And that is probably where hedge funds, the future of hedge funds may lay. They may lay in that risk management layer that sits on top. And then all the talent that feeds the hedge funds could become almost open source.
Sandy, it's all going to be AI. The asset allocation. So if there's a basket of 1,000 traders available and you train your AI on it and say, okay, this is the kind of risk profile. Can you build me a portfolio of the, everybody can become a platform. And we don't need Izzy Englander to be worth $100 billion or $200 billion to do it, because it can be done by AI for almost zero cost.
Yeah, but then there's going to be, maybe Izzy Englander can build a better AI, right? than someone who hasn't really had that experience. And then the hedge fund becomes the strength of their AI algorithm, and that becomes the platform, right? But I think your point is perfectly taken. I think that though there is skill, right? We know that there is amazing skill in being able to invest, and that skill is becoming increasingly decentralized, and we can be sourced very differently. But in the end, there still needs to be skill that builds these algorithms and trains these algorithms that to really be able to do this. And just like people are better or worse at it, my guess is that algorithms are going to be better or worse at it as well.
So the other side of this whole equation, we've kind of talked about moving this industry on chain, but what about moving the assets into crypto? Where are we with that? Because you're also involved in that whole thing as well. So where are you with all of that, with seeing what kind of demand is coming, what kind of products are needed? What's happening with the institutional investment with crypto?
Yeah, so I think institutions are investing in crypto. I think that this is one of the reasons that, some of the trading patterns feel very different now than in other cycles, because institutions are investing and institutions wait for market dips to buy, right? Institutions don't typically chase markets higher. And so you get this pattern of kind of higher lows, but not always necessarily big breakouts. And so I think that, in the altcoins, sometimes that volatility gets a little bigger because they can kind of wait for their entry points.
And they're less involved with alts as well.
That's right. And then I think in Bitcoin, right, which is probably the most liquid, you're seeing that, this pattern of higher lows keeps happening, and that will eventually create the foundation for, a move higher. But institutions don't drive markets higher in the same way that retail participation does. So I think you're already starting to feel the impact of institutions in the crypto markets. I also think that, with more regulation coming into place and more regulators looking to create clarity around what is a security, what isn't a security, what is a commodity, what is a token, I think that there's still some fundamental questions that need to be answered, and maybe some redesign that needs to happen, right? Because a lot of these blockchains use their native cryptocurrency to drive, volume, right? And to try and make the platform ever more profitable in terms of how you purchase block space, right? So as I become more successful, there's more demand for my tokens and more need to use those tokens to actually feed the transactional volumes that we're creating. But we also are using those same tokens as the investment vehicle into those platforms. So the hope is that the value of the token goes up because we want it to be an investment exposure. But in reality, the value of that token should go down as the volume grows because it's helping to drive volume.
Yeah,
so
it's really hard, this thing, because the more successful it is, the least attractive the block space is because of pricing.
Yes.
So it makes it really difficult. It'd be interesting to see how that resolves over time.
Right. So I think that we might have to just separate out the two, right? Why can't you have an investment token and a utility token?
Well, I guess that's what Base versus Ethereum is, right? You can't actually invest in Base or layer twos in general. So ETH was so successful that it became too slow, too expensive. So they had to scale the layer twos to allow high volume transactions at low fees.
Yeah. And so, that's one solution, but maybe another solution is someone like an ETH issues a utility token to buy block space and an investment token to reflect the value of the overall blockchain and its treasury, right? And then if it's an investment token, then you can also start to distribute profits from it on community votes, right? And so that becomes even more attractive as an investment instrument. And so, this whole use of tokens as an investment exposure is new. It's really only at best 15 years old. And so I think that we're still also needing to, evolve and think through some of the implications to get the whole ecosystem growing, right? Not every token is necessarily suitable as an investment token, and maybe we need to think about new options there.
One of the things interesting, I didn't think this would be the case, but we got equity wrapped crypto before we got crypto wrapped equities.
Well, we got crypto wrapped ETFs, so maybe that did come first. But yes, you're right. We did not get crypto wrapped equity.
No, we got the other way around. You know what I mean? Because we actually wrapped a bunch of crypto in an ETF to make it accessible that way around, which is not the way most people would have thought it would have happened. It was like more disruptive than that. It was actually TradFi saying, well, we like it, but we don't want to change yet. So we're going to stick with the ETF side. Do you think that at some point, I guess you're seeing this, is a lot of the time you're still having to turn into a fund structure, crypto investments for clients, whether it's the hedge funds that you have internally or whatever it is, or you have to turn it into an equity. Are you yet seeing them saying, how do we do tokens and buy tokens and hold tokens?
Only in venture, right? That's really the only place that I think we're seeing, how do I buy and hold tokens, right? It's very hard right now to get investors' heads around holding the direct tokens. I'm talking institutional investors now. I'm not talking individual investors. But I think that institutions are still not clear on the tokenomics and how they work. I think they're still not clear, or I think that they realize that there's not a lot of clarity and transparency in some protocols in terms of what their tokenomics are and how they operate. And I think that makes it more challenging, right? Not only do you have all the business dynamics that you need to model to determine the attractiveness of an investment, you also need to model these new things called token pools that there's not a lot of legal clarity around what the obligations are there. And sometimes there's not even a lot of clarity around the plans of the issuer themselves on how they're going to deal with the token pool. And then there's the whole community aspect, which they've never had to deal with in an investment before. So I think that it's still a challenge to get these institutions to understand the tokens. What we try and do through our education role is really help them to understand that there has been a reliance on open source protocols in our society for decades now, but we were never able to invest in those protocols. And that if you can get their mind around this idea that a token is not an equity, but a token is a way of sharing ownership of open source code, that starts to help. But that's a big leap for a lot of traditional
investors. And the VC team might get it again, but the general portfolio managers are like, oh, this sounds like too much like early stage technology investing.
Exactly. So I think that we'll get there, but it's much more of an educational hurdle than putting an equity into a crypto wrapper or putting crypto into an ETF, right? Those are still things that are easier for people, I think, to understand.
I think another thing that I envisage happening pretty fast is the massive pools of excess capital, the Apollos and the Blackstones and those people to enter the DeFi market in size as providers of liquidity. It's all they do anyway, right? They're massive lenders of money, credit to the system. And it feels that this is a market they'll understand very well. Sure, there's some esoteric risks, but they're used to dealing with esoteric risks too. And that we'll see, there's trillions of dollars in that market can easily go into DeFi and create enormous liquidity pools.
Yeah, and it's not even going to be DeFi or CeFi. It's going to be some interesting combination of the two, because there probably will be some regulatory boundaries that get set to make it easier for regulated entities to participate, but still maintaining some of the, I think, real opportunity space of these new models. So I think that this is going to be one of the most exciting areas we see. I completely agree. I think tons of liquidity is going to move into these new models because they really are so much more effective. And you can really time them to a much greater degree with much less difficulty than you can in any kind of financing arrangements today. And, this is where the ability to embed the smart contract in the actual instrument is going to become critical, because that's what's going to facilitate the transferability. That's what's going to allow for the secondary markets. And these are things that just don't exist in financing arrangements today. So I think that this is going to be a huge area of innovation, and the risks, we want those risks, right?
That's right.
People forget that, you make your best return in areas where there's the most risk, and you have a trusted risk manager that can hedge that out. So I think this is going to be a very exciting
And
space.
these have high rates of return. There's a lot you can do in DeFi world that is similar to the complex financialization in the finance world, where people seek returns by layering on different slices of risk. They can do all of that, and the returns are extremely high. So it's got to be attractive for them.
Well, it's this whole new concept of return stream structuring, right? We've never really been able to do that because the contracts around any type of structured trade have been so difficult to put into place and to manage. But now we're really getting to the point where I can engineer portfolios of different types of DeFi yield and return, and hedge them off in different ways, and start to have these products that build one return on top of another return on top of another return. And that's super exciting. I mean, we've just never had the financial infrastructure to be able to do that previously, but the financial knowledge is very well understood.
So we've gone through all of the things that are possible and what is happening and where we're going. I'm obsessed by distribution. I just think you're going to go to the sales force at Franklin Templeton and say, we can do this and this and this. And they're going to go, I can just sell a money market fund and get paid. How do you get through that? Because the change is not just educating the customer, it's educating your whole distribution chain as well, from internal distribution through to RIAs or third-party asset managers, or all of the clients you deal with who work for distribution. How on earth do you do that, apart from you speaking to as many people as possible?
Yes, sometimes that feels like the way we are doing it. I think that a few things here. First off, I think that we need to understand that the wallet becomes the access point to the client, right? That, that I cannot understate or cannot overstate how important this shift from account-based to wallet-based ecosystem is going to be.
So explain what that means in your head. For anybody watching this is like, I don't know really why that's a difference.
Right. So today I have a checking account. I have a savings account. I have a brokerage account. I have a retirement account. I have several of each of those sometimes, right? And who aggregates all of that? Me. Right? I'm the only person with that view into my total net worth. And therefore, I'm the only person that can look across all of these different pools of exposure and think about what's the best way for me to really utilize my set of assets. Maybe if I upload all of this information and my advisor can kind of aggregate it all, they might have a rudimentary view and be able to give me some rudimentary advice. But everything sits in so many little pockets of accounts that having one view into the potential of my portfolio is very difficult. Now, if everything were tokenized, that would all sit in my cryptographically protected wallet, right? My operating capital would be sitting there in the form of stablecoins or tokenized money market funds or tokenized deposits or central bank digital currency. My investments would be sitting there in the form of tokenized equities or tokenized portfolios or crypto. My real estate exposures might be sitting there in the form of tokenized deeds or tokenized home equity that I can be able to then allocate if I wanted to, right? All of my different assets would be sitting in my wallet. Right. And having all of those assets in my wallet then gives me one view into my totality of my wealth that I can put those algorithms that we were talking about, these allocation and risk algorithms on top of, and they can start to optimize my use of all my assets. And getting them all into the same container is the first part of that challenge. And this is what I mean by the shift from an account-based system where all my assets are held in all of these different little pools in all of these different little locations, into a wallet-based ecosystem where all of these assets are sitting in my cryptographically protected wallet that any blockchain can access if I give them my private key to unlock and send assets to that holding. So I think that this is where the biggest shift needs to occur, and that distribution will become via the wallet. I will offer you in your wallet services. I will offer you in your wallet product, and it will go based on algorithms that are telling me what might be useful. I think of the wallet as my Uber portfolio of everything I own.
But somewhere within that, we're going to need zero knowledge proofs and stuff like that, because in the end, this becomes very sensitive. You don't want to show people your bank account. Crypto right now is, as soon as somebody knows your wallet, they can see everything. And so we have to get to a place where we can obscure that, because institutions will not carry gazillions of dollars of different exposures for everybody to see what they're doing.
Yeah, I think zero knowledge proofs are going to be a foundational component of the future ecosystem without any doubt, right? We need to get to this point where, and we need new identity solutions that move with transactions, right? And so I think those are also two components that will become part of this world, but we're already seeing great use cases emerging there, great new offerings emerging there, right? So I think that all of the components that we need to make this shift from the account-based to the wallet-based world are on the table. It's just a matter of waiting for them to be pulled together in a really effective way that give us this opportunity to really unlock this space. And that's where I think distribution moves, right? And then I think what we think of today as sales or distribution, these people become almost consultants to human advisors that are trying to keep trust in how these algorithms manage the portfolio, right? I really think that advisors, they will remain important because people like to talk to people about their money, right? But what they will be doing is they will be really handling the relationship piece, not the money and the optimization piece of the portfolio.
But to go back to the question, today, when you're trying to distribute new product that you've come, how do you get the distribution to even understand this stuff? Or do you just selectively go out and find kind of flagship clients who are interested in doing something, try it out, see how it works, and kind of build momentum that way?
Yeah, we're doing a little of both. I mean, we are training. We have a lot of training that we do of our sales force, particularly for the products that they should be able to understand a little easier, the crypto ETFs, some of these new tokenized equities and funds that are coming, right? That will be a little easier to train the existing sales force on how to really work with us. We're hiring some new types of specialists that can really go into channels and talk about the new technology and why these new products might be more suitable. So, the tokenized money market funds are a great example of, it's not something that you typically go into, the chief sourcing manager of a large corporation and talk to them about their supply chain management through an investment product, right? So we're opening up some new channels there. But I think that, a lot of it is going to be that these products become direct to consumer, right? This has been the trend in the industry. And, it's going to become more and more about putting the product availability and the education to really, and the analytics that show how these products impact the portfolio in front of the individual. And I think that's more and more where a lot of this is going to migrate.
A final question for you on all of this is custody. So you've got your own wallet, you've got your own self-custody, which is a great thing and a terrifying thing. The reason I got into all of this in the beginning is realizing that in the financial system, in the financial crisis, nobody owned anything because it was all rehypothecated. And then I lived through the European sovereign crisis where all the money got taken out of the banks in Cyprus and in Spain. And you realize you actually don't own your money in the bank. So then you think self-custody, this is the way. And then you're like, holy shit, I'm now responsible for this. There's no 1-800 number to call when something goes wrong. How do you think of that? You're custodians as well for assets as well. Is that how you do it?
No, we are not a custodian.
You're not a custodian.
But I do think that it's a very important point. And here's where the word custody, I think, does us a disservice, right? So there is the way we think of custody today is that the custodian holds the assets, right? And that the assets are what is valuable, right? And in the future, when I have a wallet, my assets sit in my wallet. And of course, my assets are valuable, but the thing that is the most valuable is the key to open and close my wallet. And so when we talk about crypto custody, what we're really talking about is custody of the key. And that is a mathematical string, and that is something that these custodians are breaking up and making dynamic. So it becomes almost impossible to put your key together unless you give a certain type of authorization. And so I think self-custody of assets does not mean not using a custodian for your wallet, right? And I think that the custodian for the wallet will be the key manager. And we almost should start to call them that as opposed to custodians, because I think it would help people get their mind around the role of these entities in the future.
Yeah, because they're kind of your security team for your vault, you know?
Yes, exactly. They're like your cybersecurity manager, right?
Exactly right. Sandy, as ever, fascinating conversation. We do live a few years in the future, but so far, most of our conversation, everything seems to be moving that way. And as ever, I'm sure I'll catch up with you in a few months' time to figure out where we are today. But thank you as ever.
Well, thank you, Raul. I love our conversations. I think you're really one of the top thinkers we have in the entire industry. So it's a pleasure to be able to speak with you.
Thank you, Sandy. As ever, charming, interesting, fabulous conversation with Sandy. We all get to peek over her shoulder of what's actually happening, what companies like Franklin Templeton are doing, and where the world could be going. So it's much bigger still than most people imagine. And that's what I try and do here, is help you understand where this is really going.
Hey, Real Vision viewers, a quick pause to introduce you to today's sponsor, Axelar. Axelar is building the rails for the next wave of global finance. Not just crypto, but the future of how assets move, how markets connect, and how institutions plug into open systems. Think of it this way. Bitcoin brought digital gold, Ethereum brought smart contracts, but Axelar is bringing connectivity, the secure link between your favorite blockchain and traditional financial institutions, rushing to plug in. It's why top-tier firms like Dragonfly, Polychain, Coinbase Ventures, and Binance Labs are backing Axelar, and why global giants like Deutsche Bank, MasterCard, Apollo Global, and JP Morgan are already building on it. If you believe the future of finance is open, programmable, and interoperable, Axelar is the gateway. Want to digest deeper? Visit realvision.com/Axelar or follow on X at Axelar. That's AXELAR, the gateway to open finance. Today's video is sponsored by VeChain, the leading layer 1 built for real-world adoption. VeChain launched all the way back in 2015, built for real-world utility before most people had even heard of blockchain. One of the oldest protocols and boasting 100% uptime since launch, it's known for powering real-world solutions and partnerships with global brands like the UFC. Now, they're entering a new, user-focused chapter powered by adoption in the vBetter ecosystem and an ambitious technical roadmap dubbed the VeChain Renaissance. Renaissance builds on VeChain's history of real utility and adoption to deliver a faster, more flexible core protocol, designed to meet the needs of builders and drive mass adoption. The next phase kicks off on July 1st with the launch of Stargate, VeChain's new staking program. It's an evolution that brings VeChain closer to delivering its vision of a world powered by Web3 without compromising on reliability or stability. The future is here, and it's scalable, sustainable, and evolving with purpose. Check the links in the description to find out all you need to know about VeChain Renaissance and the updated staking opportunities available through Stargate.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.